I read what you wrote, and I see you trimming your baseline forecast by a little bit, but warning the risks are heavily, as we say, heavily skewed to the downside. Does that mean that I should be reading your baseline as being potentially over-optimistic?
Well, no, I mean, the baseline is the baseline, so that's still where we believe that things might unfold. And as you pointed out, it's a slight downward revision for this year and next year at 2.8% and 3%. And this is reflecting basically the fact that we have, advanced economies are reopening, are moving ahead, China reopening, and at the same time we have the tightening of monetary policy that is weighing in. Plus a little bit of financial instability that could weigh down on bank lending, for instance. So you put all of this in the mix, and that's where you have our baseline. The concern we have is that there could be a lot of things going off the rails, if you want, and in particular in the financial stability space. And so that's why we offer, in addition to the baseline, two other scenarios where we amp up, if you want, financial instability, and we look at the consequences might be.
So let's talk about the consequences when it comes to, say, SVB and Credit Suisse. How do you think about that?
Well, very clearly, what we are seeing is with a very sharp increase in interest rates by central banks around the world in the last year, that's creating pockets of vulnerability in the financial system, both in the banks, as we've seen with SVB, and in the non-banks. We had the UK episode last fall with the LDIs, the liquidity-driven investments. And so we have to be vigilant because some of these pockets of vulnerabilities could spread, and then they could spread to the whole financial system. Now, this is not where we are, and the authorities have been dealing with that. But what we are seeing right now is the risk that banks are going to look at the outlook. They're going to look at their bottom line. They have to pay more for deposits. They're losing deposits. They're booking losses on the asset side, on the holdings of long-dated fixed income assets. And they're going to be a little bit more prudent in extending loans going forward. And that could weigh down further on economic growth, both in the US and in the rest of the world.
If we get that credit tightening, if we get that potential credit crunch, Pierre-Olivier, how quickly does that show up in inflation? What is the relationship in the way you're looking at this, your models are showing it, between tightening credit standards and inflation coming down maybe potentially more rapidly?
Yeah, well, this is the other part of the story. We've seen inflation being more persistent, stickier than we'd like. And to some extent, this contraction in lending, if it were to happen, it would knock off a little bit of the growth. We estimate that, if we have a contraction of lending that's about 2% of real lending, then that would knock off about 0.3% of output this year, bringing growth to 2.5%. And it would moderate a little bit inflation pressures for this year and next year. So he would, in a sense, substitute for more monetary policy tightening to some extent.
Right. But yet, Pierre-Olivier, the markets are pricing in cuts, at least when it comes to the Fed. In that scenario that you just laid out, will central banks be able to continue to hike, or will they hold, or do they need to cut?
If we have the type of contraction in lending I just described, about 2% of contraction in lending in the US and in a number of other advanced economies, our projection suggests that then the Federal Reserve would be able to cut rates modestly by maybe, we estimate, about 40 basis points. What's important to realize is that this is in response to a softening of the economy because of the contraction in lending. This is not because of some concern about financial stability per se. It's responding very narrowly to its mandate, which is to try to achieve a certain stance of monetary policy to bring down price inflation.
Pierre-Olivier, there are still a number of significant tailwinds for the global economy. You're describing headwinds. We have a Chinese economy that is reopening. Europe has weathered its storm on the energy front relatively well and looks well set up going into next winter. There's a number of tailwinds that are currently impacting the global economy. To what extent does the credit tightening that you're describing, the rising cost of money that you're talking about, offset some of those benefits? And where do you think the balance currently lies in terms of the tailwinds and headwinds?
Well, this is how we define our baseline. You're absolutely right. It's not just all downwinds or headwinds. because we have, in particular, when we look at emerging Asia, look at China, you look at India, we have very strong performance this year and into next year. The reopening of China, we anticipate a growth rate of 5.2%. In India, there is a slightly lower growth rates for 2023, but it's still very robust, close to 6%. And so these two countries, large economies growing at such rapid rates, this is really pulling the rest of the world along. So you are absolutely right. On balance, we have these concerns about contraction in lending, but we also have emerging market economies powering ahead. And we've had quite a bit of resilience, as you point out, in European economies to the energy crisis and the impact of the Russian invasion of Ukraine.
So this sets me up nicely to talk about the energy transition, because if what we're seeing in Europe is sort of a really speeding up of the energy transition, and I'm wondering how the IMF is looking at that in terms of growth. You're going to see a lot of trade flows are going to be disrupted. It's also going to lead to more reshoring and onshoring and a huge disruption of the energy market. How do you guys model that? What's the effect on growth and inflation?
Well, we look at that fairly closely, and we actually did a whole study of this in our previous World Economic Outlook back in October, where we looked at the short-term impact of the climate transition, in particular the impact it could have on inflation and growth. And we found that there were some modest effects. It would increase, the climate transition is going to raise the cost of energy, at least in the near term, because you need to substitute and move away from carbon-based sources of energy. That's going to increase the cost of energy, and that's going to feed into inflation. But the effects was relatively modest and certainly could be absorbed and could be dealt with. So we do find this effect. Now, when you look a little bit under the hood, you find also a lot of heterogeneity across different regions. What we did in the current World Economic Outlook, we have a special focus on those countries that are, large producers of fossil fuel energies, whether they are oil or gas or coal producers. And we look at what happened if they have to quickly pivot away from this sort of extractive source of growth. And we find that the effects on these countries could be actually quite large and negative, both in terms of the decline in output, decline in investment, a worsening of their trade balance, a depreciation of their currency, and even the manufacturing sector, which in some cases, when you're a commodity-driven economy, your manufacturing sector suffers. Well, we found that in many of these countries, the manufacturing sector, because it's so specialized around energy production, would also suffer.